have beaten this inflation argument to death. However, we have some possible good news coming up next week, Wednesday, when the Fed meets. And a lot of the inputs that they're getting, they got some on Friday, and they're going to get some more information on Tuesday, the CPI and the PPI, Derek.
On Friday, we heard from the government on the producer price index, and essentially it was a disappointing number. Food prices were up actually 3.3% in November on a month-over-month basis. So inflation continues to be an issue, and the CPI, of course, will be reported on Tuesday. Then we hear from the FOMC on Wednesday.
That's right, on Wednesday, and that's what we're expecting is a 50 basis point hike. And why that is significant is you'll recall that in the beginning of the year, pre-March, we were at essentially a 0% bound range, 0%. And they have raised the rates 6 times already, and a 7th time coming on Wednesday. And it's the fastest rate increase we've ever seen in our careers, and number of increases. So we're going to try to comprehend what the Fed is saying on Wednesday, that are they near the end of this rate raising cycle?
And the good news is if they do raise it 50 basis points, that'll put us at 4.5% on the Fed funds rate, which will be higher than the 2-year yield. And what we've often said is the 2-year yield really does the work for the Fed. So the Fed is now caught up. They were behind the curve. Now they've caught up. We've seen all sorts of secondary indications that inflation is easing, whether it's used car prices, the price of lumber, price of gasoline. So it's really what I'm going to focus on, not so much is what they do in terms of the rate, it's what they say in terms of guidance. Are they going to say, maybe we're going to pause and see what the data suggests?
Yeah, and again, you just said the word that I'm going to look for, Derek, is parity, or something like market neutral. And again, we always say don't fight the Fed, but the Fed is looking at market rates. So as you said, if they've raised that short-term interest rate over the 2-year number, they are in somewhere in the neighborhood of market parity. We'll have to listen to, and of course, they do know that all of these rate raises have a lagging effect. And why that's important is because as we go into 2023, we will see a slowdown. And in fact, the base case for most economists that we will have a recession in 2023.
That's the thought. The one good thing the Fed has on its side, however, is that consumer balance sheets are in terrific shape. And 70% of the U.S. economy is consumer driven. And we saw that. We got the PMI, both manufacturing and services. Manufacturing PMI is already in a recession, but services are not. 57 was the report. That's an expansion. And consumers have a lot of cash. They don't really care what the Fed funds is doing as long as they have cash in their wallets.
And that may start to dissipate, however, because credit card usage is going up. Our savings rates are going down. And we've seen a lot of distributions or requests from distributions from companies for employees getting their 401ks out. So there is a stress indicator. That stress indicator is up. And it's actually a statistic that you showed me called the stress indicator.
It's wild. You add up the year-over-year change in food prices, what current mortgage rates are, and what the price of gasoline has done. And that's at a very elevated level. It started to turn down, but usually when you see situations like that, that is what causes the Fed to tighten and trigger a recession. So again, the jury's out. The United States has been an oasis. We're certainly doing better than other parts of the world in terms of inflation, and the Fed has been very aggressive, and the U.S. consumer is still in good shape.
And so the final takeaway, of course, is, you like to be a contrarian, and when most economists say that we are going to have a recession, there's a possibility that will not happen. And so we could get a counter trend rally that is not expected. And of course, that is why you always talk about a balanced portfolio.
And, and one thing I saw this week, Wall Street strategists in December published their forecast for 2023. For the first time in 42 years, they actually project a down market in 2023.
We'll see if they're right.